The subject of this webinar is Silicon Valley real estate in a bubble. We'll start with taking a few seconds and talk about ourselves. I'm doing professionally real estate since March of 2005, so it's literally almost 14 years of being directly involved in many aspects of real estate. We also expanded our team. We have Nati, Ella, Asaf, and Amit, and they are all realtors. Nati is focused on real estate investing out of Silicon Valley. Ella and Asaf are focused on residential real estate in Silicon Valley. And Amit, who is doing commercial real estate, acts as a capacity of advisor and commercial real estate as we look both in locally as well as outside of the area. As far as myself, I've been in high tech for over 20 years. Some of the companies that I work for are recognized to you. Some do no longer exist. In addition, I've been the founder of 3 high-tech startups. Anyone who is interested to read more about that background can go to my LinkedIn profile and we'll find the details over there. As far as the real estate goes, my wife and I, who arrived to Silicon Valley in 1985, where we have done many transactions prior to becoming professional real estate, involving professionally in real estate, been buying homes in Silicon Valley as well as investing across the country. Investing is something which I'm very passionate about, and we have a seminar which I'm going to touch in a few minutes. As far as our career accomplishment as professional realtors, I'm very proud of the fact that a lot of our clients really appreciate our service. We believe in what's called holistic realtor services, which does versus a transactional one, where we provide a variety of services along the entire life cycle of real estate ownership. These presentations are loaded with information about what happened in the market, what are the strategic reasons to buy or not to buy a home in Silicon Valley, timing of buying, how to buy, what to buy, and so a lot of information. With that in mind, let's dive into the presentation itself. I want to ask you this question, based on what you have read, based on what you perceive is the market. Do you believe that Silicon Valley real estate is in a bubble? So, as you can see, the question of whether Silicon Valley is in a bubble or not is not a new question. This is an article from June of 2013. And if we take a look at this article, which was published in June 13, we see here kind of 3 bubbles. One was when the bubble burst, which is July 2007, where the median price was $738,000. Post the bottom of the market, which was in March of 2009, median prices were about $295. When this article was published back in 2013, the median price in Silicon Valley was $564. I will touch this question of median price and average price a little bit later and share with you why I believe that this is a little bit misleading. Nevertheless, though, the key difficulty of answering this question, whether Silicon Valley is in a bubble or any asset is in a bubble or not, is the fact that basically there is a question of what is the definition of a bubble. So I researched this subject and found the following definition of a bubble. A bubble is a financial phenomenon characterized by a surge in asset, and that applies to whatever asset class, whether it's stock, real estate, or others, and to a level significantly above the fundamental value of that asset. At some point, demand decreases or stagnates while supply increases. resulting in a sharp drop in prices, and the bubble burst. So as you can see, I've tried to dissect this statement, and number one is prices, number two is fundamental value, number three is demand, and number four is prices drop. So in the next few 45 minutes or half an hour, we're going to spend time discussing each one of those aspects of that definition. And hopefully, as we go, we're going to have a better clarity in terms of what is the bubble and whether Silicon Valley real estate is actually in a bubble or not. So let's get started. To start, let's understand what are the factors that are impacting real estate market in general. The chart that we are looking at is a chart that was developed by S&P Case-Shiller. This is a national home price index, and the red chart is representing the home price index over since the late 1880s. And what we see here, that those prices obviously fluctuate over time, and the dotted line here next to the 100 is inflation adjusted. So if we're going to focus primarily on the period from the end of Second World War forward, we'll see that obviously there are fluctuations in the prices, and there we see some bumps here, which we're going to touch a little bit later. And we're going to talk about now of what are the factors that are impacting the real estate prices in general. So to start with, we understand that interest rate is a major factor, obviously, that impacts the real estate market, and that is simply because the fact that the majority of people who buy homes, their homes in Silicon Valley, are using a mortgage, and obviously, the higher the mortgage, the less they can afford buying. So clearly, mortgage is a big factor, and as you can see, in the 80s, we had an incredible inflation of 21%, where it resulted in an interest rate of about 21%. Currently, the rate that we are experiencing in this time is about 4%, and that is definitely, and obviously depends on other factors, what is the actual rate you're going to get. The other factor that impacting the real estate market is obviously population, which is basically the demand side. And as you see, the population in the United States until Second War was growing at some pace, and since the Second World War, we are growing approximately between 0.8% to 1% per year, which means as of December of last year, 328 million people live in the United States, which basically says, according to those numbers, so roughly about 3 million people need new housing each year, which is an enormous number of people, and obviously that represent the demand side. The other factor that impacting real estate home prices is obviously building costs, which can be from cost of material, concrete, cement, wood, copper, and so on and so forth, labor, and so on, and obviously cost of land as well. So we see that also is fluctuated based on the economic condition locally, as well as impacted by worldwide supply and demand for those such material. So now, if we look at the home price index, what we see here that back in the 80s, we see some increase in prices, and after a moderate increase, we see a correction. Then we see another increase in prices in the late 80s, in the mid 80s, early 90s, and another correction. And back in the beginning of the 2000s, we see another increase in prices, and obviously until the crash of 2007, which didn't result just in a real estate bubble crash, but it actually resulted in a worldwide economic recession. So that's obviously the price collapsed dramatically across the US and other part of the world. So the question now is, where are we today compared to where we have been back then? So these two charts that I'm going to share with you in a second shows us the Case-Shiller chart for back at the beginning of this year, where we see the housing bubble number one, which they referred to the one that basically burst in 2007. We see across the United States about 27% drop in home prices, and lo and behold, we are about 8% higher than what we used to be back then. So the question is really, is a housing bubble number two? Are we heading to a housing bubble number two? Now let's take a look at what are the prices in Silicon Valley, San Francisco Bay Area. So what we see here, that in the bubble number two, in general, prices drop about 30%, while currently in bubble number two, question mark, is that prices are higher by 37%. So based on that assumption alone, I would guess that it's fair to say that that Silicon Valley real estate is in a bubble, if that was the only factor that we will be is under consideration, because we definitely see that if we crash here in 2007, while the prices were 37% lower than why today, then obviously we are in a bubble today. But that's only one angle of that, and let's dive more into other aspects of that question. So some of the question that we have to address is, obviously, if we look at prices and we talk about how that behave then and where we are today. So first of all, what we see in this chart is a chart of about 19 years of Santa Clara County home prices, and we see the average price, which is in red, the average, which is in blue, and red, which is the median price. And what we see here, that we do have a divergence between the median and average, and we'll talk about it in a second. But if we look back for a second, this is the dot-com crash, where Silicon Valley and Detroit were the only states in the United States that actually suffered from downward prices in real estate. And as we can see, even though Silicon Valley had a major correction due to the dot-com crash, where we lost almost 250,000 jobs, the correction in the prices, both median and average, was not as dramatic as one would expect. If we look at the financial crisis that started back in 2007 and the kind of correction we experienced during that period of time, we see it's a much more dramatic one. And that was not just a Silicon Valley correction, but that was a global economic crisis that spread all over, obviously all over the world, all over the United States, and so on. And we can see here that we do have a divergence between median and average, and that's simply because in Silicon Valley, on one hand, we have homes that are selling for $500,000, and on the other hand, we have homes that can sell for many, many millions and even tens of millions of dollars. So, in addition, I want to touch the misinformation that is conveyed by the median and average price, because unlike Case-Shiller, which basically compare the same home prices in different time, median and average prices are basically determined by what is currently sold in the market. And if we look at August 2007, we see that almost 94% of homes that were on the market and sold were above the $500,000 price point. A year later, we see that that number has changed dramatically, that homes under $500,000 were almost 35% of the market, which is almost a five-fold increase compared to the previous year. So basically, the explanation for that is that once people who lost their job due to the economic crisis and they could not make the payments, the lower demographic of this area was not able to sustain the mortgage payment, and they had to sell the home. And since the market was flooded with home, they would basically sell it for whatever the price they can get, while the stronger demographics, where they did not get the kind of prices they were expecting, they were able to make the payment and continue with that conversation, with holding the price, holding the home and not selling it actually. So if we look at where we are today compared to those times, so we see that the Sunnyvale, as of end of last year, Sunnyvale median price is 1.8, and the kind of household income that it takes to qualify for buying this house under with 20% down, 30-year fixed loan, a loan of about 4%, when the debt to income ratio is below 43%, and so on. So these are the kind of prices that an income that we currently are experiencing in Silicon Valley. So in San Jose, from $155,000 household income to Menlo Park, $354,000 of household income requires to buy the median prices. So the question now is, given that reality, so, and actually a very interesting point is that we see that in Silicon Valley, the low income is considered $117,000. So in a sense, what we see here, that Silicon Valley is literally experiencing level of income that is unheard of in many parts of the country. If we look at the fact that the median income in the United States is somewhere about $50,000, so you see that people make a lot of money here, but obviously it's very expensive to live in Silicon Valley. So now let's take a look. So the question now is, if that's the kind of money that is required to buy a home in Silicon Valley, how many people are really qualified to that, and what is the affordability in Silicon Valley? So what we're looking at right now is the affordability in Silicon Valley and in California in general, up to Q4 of 2018. A Q1 number of 2019 will be published in about a month, and once we have it, I can share that information with you. So what we're currently looking at is we're looking at the chart, the affordability chart in San Mateo, affordability chart in Santa Clara County, and affordability in general measures the ratio between the median house price to median income, which, given the current cost of capital, was 20% down, relatively good credit, and so on. So what we see here, that back just before the crash in 2007, the affordability in San Mateo County were about 8%, while the affordability in Santa Clara was about 11%. In the bottom of the market, which was 2009, the most affordable homes were in the valley were San Mateo County about 32%, and Santa Clara County 44%. So obviously everyone is curious to see, so where are we today? Well, we see that today we are roughly in San Mateo County about 15% and 18% in Santa Clara, which basically translate to about 15% of the population can afford buying the median home in Menlo Park, and 18% can afford buying the median home price in Santa Clara County. But that information is also a little bit misleading, because what we are measuring is not necessarily the people who are currently in the market to buy a home in these particular counties, but we're measuring the general population median income compared to the median price point in this particular area. So that is not exactly an accurate depiction of the condition. And the accurate prediction is based on what are the bank requirements of obtaining a loan, which we're going to touch a little bit later. So I'm sure some of you are curious to understand and asking themselves, how come home affordability went up in the last quarter of last year? The answer to that is that, as we can see, interest rate have dramatically dropped since. So with the announcement of the Feds that they would no longer increase rate back in December 24, we see that the interest rate have dropped dramatically, which resulted basically in the affordability going higher. So the question now becomes, so okay, we know that Silicon Valley is very expensive. We know that people in Silicon Valley making good money, but how really on the demand side, how many people can afford buying those different homes in Silicon Valley? So we have here data from Joint Venture Silicon Valley, which is each one of you can open that report and look at many different interesting statistics about what's going on in Silicon Valley. Among them, they talk about employment and payment and so on. So, and in our area, they divide it into 3 tiers. Tier 1 is defined as the professional, the engineers, the lawyers, the doctors, and so on and so forth. And what we see here that roughly about almost 350, 375,000 people are deployed in this category of tier 1. So the question is, in terms of income, what is the median wages for tier 1? And among those 350, 375,000 people employed on this tier 1 category, we see that the median price is about approximately $115,000, which means that half of them making that kind of money and half of them making more. If we look at household income, because particularly in our area, we have a lot of household where both husband and wife are working. And what we see here that about 26% of household in Silicon Valley are making over 200,000. And if we look at what was the median price, and we see that 26% of them are making over $200,000. So we started to get a feeling that there are enough people in this area that are making enough money that they can afford the kind of payment. On top of that, if we look at how much disposable income those people have, well, we see again from the Silicon Valley joint venture study that first of all, between 2015 and 17, the disposable income went up. And there are roughly about 17% of people who have at least $500,000 of investable asset that they can use for the down payment. Can be cash, can be stocks, whatever you want to consider. So basically, the objective of this last slide is to actually share with you that there is enough critical mass of people who are making very decent wages, as well as have a decent down payment to buy the kind of home that they want to buy in Silicon Valley. So let's go to the next bullet, significantly above the fundamental value of an asset. This one really is a hard one. It's a tough question. Significantly above the fundamental value of an asset. And here is the problem. The problem with this simple statement is that bubbles are very often hard to detect because there is a broad disagreement over the fundamental value of an asset, how to measure its fair market value. This is a very simple question, but the answer to that is not trivial at all. So let's try to answer this question. So in a free market, how one determines the fundamental value of a house? Okay, we are now talking about homes, so this is the relevant asset class that we're talking about. So how does one determine what is a fair market value of a house? So when you are a cash buyer, when you're buying a home, so whatever a buyer is willing and able to pay, that's his own, the buyer's discretionary. They're going to decide what it's worth for them, and that's it. When we use a mortgage, there is another player here, and the player is a bank, and the bank basically lends you money, and he uses the house as a collateral, and as a collateral, they have to determine whether it's there is enough equity in the house in the event that the buyer defaults. So, and basically, I don't know of any other way that you can determine what is a fair fundamental value of an asset. If you guys have any ideas, please share them with us. We'll appreciate it. And in general, a market exists whenever there is a disagreement over the fundamental and the future value of an asset. Under normal circumstances, when somebody is not pressed to sell, and is not living the area, and when we're talking about homes in general, then basically if one sells, it's because he believes that maybe he has enough equity or he won't diverge or whatever, but he believes that there's a diminishing return from his perspective, while others believe that the future is positive, and they basically jump into the market. So a market exists only when there is a disagreement about fundamental value as well as future value of a particular asset. And obviously there are other needs that has to be taken into account as well, but this is kind of a philosophical question, and I will leave it with that. And if you guys want to share with me what is your belief, then I will definitely appreciate that. So the fundamental question is one of the most difficult questions to answer, and I don't know if that if you are satisfied with the answer, but it is that's my understanding at this time. So let's talk about the third point. Demand decreases or stagnates while supply increases. So what we're seeing here a chart of, again, 19 years of Silicon Valley, Santa Clara County chart that shows us supply versus demand. The blue is the supply and the red is the demand. And if we can look over a long period of time, we see that roughly the demands, I would say the moving average of the demand is probably about 1,000 homes per month. And when we look at the inventory level, we see a few things. To start with, this is the 2001 dot-com crash, where we had almost 5 homes for every potential buyer. And we see here a dip in the demand state. So here we see roughly about 5 homes per buyer. Here in the economic crisis of 2007, we see almost 7.5 homes for every buyer. So obviously, this is very much a buyer market. This is very much a buyer market. Anytime there is such a discrepancy between supply and demand, obviously it changes. So what are we going to look at now is a few trends in the market. We'll see, first of all, that the market has 2 cycles. One is the seasonality of the cycle, where always the bottom is December, November, December, January. The top of the market is typically June, July, August, and so on and so forth. So even though we see increase in the supply, we still see the demand, the behavior, the seasonality of the market. The other cycle that we're referring to is what I call the economic cycles. And that is basically the cycle of when we had the dot-com crash, a high increase in inventory, and inventory drops toward the 2005. 2005, we see another increase in inventory, and again, a correction. And look where we are today, where we still maintain the same seasonality of the cycle, but the relationship between supply and demand, it's much more tighter than we have seen for quite some time. If we now project that to prices, what happened to prices during those times? So what we see here, as we indicated earlier, that even though we had a major access supply here, prices in Silicon Valley have not dropped dramatically compared to what we see here, where we have the economic crisis. We see that major drop. And as we discussed earlier, we have to be very careful when we look at median and average and look at the mix, because by the end of the day, the price that really matters is the price where you want to buy, in what neighborhood, and what area, what type of house, and so on. So that is very important to watch the impact of inventory and prices, as we see here and as we see in this area. Okay. Another point that I want to bring to your attention is that if you look at the cycle of the price, that most of the appreciation happens in the Q1 and Q2. So you see, this is the beginning of the year, prices goes up, then stay flat, prices go up, then stay flat, and so on. So most of the appreciation typically happens when inventory levels are low, if you look at that, inventory level are low, then leveling. When inventory are going up, prices getting flat. And that's a very classical behavior of supply and demand. Good. Another thing that I want to show you is the fourth point, which is basically a sharp drop in prices. Okay, so if we look at here, I picked up two places, Palo Alto and Sunnyvale, and what we see here that this is a kind of a 12 months perspective. We do see some price fluctuation, as we see. If this is the beginning of the year, prices go, and every different city behave differently, depends on what's currently on the market, and so on and so forth. And we see also a price fluctuation in Sunnyvale as well, where we see the green being the average price and the median price is blue, basically. And when we look at another relationship, a lighter relationship, we look at what's called buyer's market versus seller's market. So obviously, this is the period of the economic crisis where clearly we were in a buyer's market. And as of 2012, we see that we have dropped into the seller market. And we have been in the seller market since roughly 2012. Obviously, what we see here, interestingly enough, is that there was a little bit of a change where market was heading to a buyer market. What with the interest rate announcement of the Feds, and so at that time we see a drop back into the seller market, and that's also being reflected in the prices. So if we look at the relationship between sales price to list price, this is basically the 100% where sales price equal list price. We see that during that period, since being in the seller market in 2012, prices typically were above asking price because we had limited supply and the demand was over the supply. And again, look at the seasonality of the market, when prices going up in the beginning of the year, dropping, going up in the beginning of the year and dropping. And again, if we look here at this time, where we definitely saw the correction of the market starting in second half of last year. If we look here, we see an increase here. Basically, back prices start to hedge up higher compared to what they were. So this is where we are today. So what I want to do now is basically we are now it's 11:40. And I want to now review some of the points that we brought up with the conversation. So what is the definition of a bubble? We talked about the asset prices. We talked about the fundamental value. We talk about demand versus supply. And we talk about sharp drop in prices. So in my point of view, when we look at this definition and look at each one of those elements that make the definition, in my opinion, we are not in a bubble, okay? But let me bring another perspective to this conversation, and that is a conversation, perspective of Robert Shiller. Some of you might have heard about Robert Shiller. Robert Shiller is a Yale professor to economics in Yale University. He won the Nobel Prize for predicting the dot-com crash as well as the real estate crash. And Robert Shiller was asked back in 2010 for his definition of what is a bubble. And he basically have about 8 categories to his definition of how to spot a bubble. So a sharp increase in the price of an asset like a real estate or shares. So we do see a sharp increase. Nobody argues that. We clearly see that. A great public excitement about the said increase. There is conversation. There is discussion. But anyone who can remember the 2007 crash, the kind of conversation that we hear today in the media and so on is by far not even close to that. There are conversations, they're more concerned there rather than excitement about it. And the accompanying media frenzy, as I touched, I don't see that much of that. There is conversation, mostly concern rather than frenzy about this topic. Stories of people earning a lot of money causing envy. I don't see that, because in our area, typically, you don't see a lot of flippers. You see some, and I can share with you some stories about recent flippers that actually lost a lot of money. So people don't buy here. Typically, the homeowners who work in Silicon Valley and see that is their home, they don't buy homes to flip. They buy home to live in it, to be next to good schools and so on, and obviously have family life and so on. A growing interest in the asset class among general public, I would not say that. Anyone of you who've seen the movie The Big Short and remember stories about people buying 5, 10 homes, and people who are where, I think one of the story in Florida was that a stripper bought 10 homes. I would encourage you to read the book The Big Short. It gives you a good perspective of really what happened and what went wrong. So I don't see a lot of that. New era stories about justifying unprecedented price, I do not see that at all. A declining lending standard, I absolutely do not see that either. So according to Robert Shiller definition, I do not see signs of a bubble. There is another, Freddie Mac also has another guidelines of how to spot the bubble. And they have a two-step process. Is the number one, using a price-to-income ratio to spot the markets out of bound. So basically, we see that in Silicon Valley right now, as we indicated before, in Santa Clara, we have about 18%, and in San Mateo, we have about 14%. So these are low, not as much as we saw in 2007. And as well as I indicated earlier, this is something which is a little bit distorted. So that is something that you want to keep in mind. And the second step, where they look at that, they ask those 3 questions. Number one, are there a non-financial reason for the high PTI, price to index ratios? Is there a rapid growth in a geographically specific industry that explains the current PTI? Okay, and clearly in Silicon Valley, we see an area that is growing rapidly, an area that is attracting a lot of high people with high education, high income, household income. And as far as I can tell right now, I don't see any signs for slowdown. So basically, we have a good geographical concentration of an industry here that attracts a lot of highly educated people who have a lot of money. The second question that has to be asked, are credit conditions deteriorating? And I can tell you, as someone who have done a lot of loans, and I do have some cash client as well, but majority of my clients, I would say 90% of my clients are mortgage buyers. And I can tell you, banks are very, very tough. They look at your credit, your income, your FICO score, debt to income ratio, and so on. And the lending criteria that we are experiencing today is nothing near or close to what was back in between 2001 to 2007. Nothing to compare. The third point is leverage. Again, I do not see an increased level of leverages. I do not see that. Banks would not lend you money if they cannot prove your financial stability, your down payment, your income, your FICO score, the debt to income, and all those kind of criteria. So in my humble opinion, based on both the data that we looked at, based on the criteria by Robert Shiller and Freddie Mac, I personally do not see a bubble.